Assalamualaikum warahmatullahi wabarakatuh. Hello, ladies and gentlemen. Let me introduce myself. I'm Atqia Kumala, studying of Accounting Program, Faculty of Economics, Islamic Sultan Agung University, Semarang, Indonesia. As you can see on the screen, our topic today is income statement. The topic is very important for you because income statement will tell the story about the performance of your business over a certain time period such as monthly, quarterly, or annually. I've divided my presentation into 6 main parts: definition, benefit, structure, types, example, and steps for income statement. In my presentation, I'll focus on 3 major issues. First of all, I'll be looking at what is an income statement. Second, structure of income statement. And third, steps to prepare income statement. I'll begin explaining what is an income statement. Then I'll go to why is an income statement useful. After that, I'll consider what goes into an income statement. Next, I'll mention what are types of income statement. Finally, what goes into an income statement. My presentation will take about 20 minutes. Don't worry about taking notes. You can download my PowerPoint on link in the description box. And if you have any question, feel free to interrupt me at any time. So, do we really need income statement? Is income statement important for a business? Income statement will show whether a company is making profit or loss for a given period. And from there we can find out what things a business needs to do in order to be more profitable in the future. Let's begin by definition of income statement. What is an income statement? The income statement is one of 3 financial statements that are important for business of all size. The other two, the balance sheet and shareholder equity, go hand in hand with the income statement. The income statement is often referred to as the statement of income, statement of earnings, or statement of operation. But all of those terms mean the same thing, your profit and losses. Well, I've told you about the definition of income statement. Now we move on to why is income statement useful. An income statement helps you to track the cost of sales, assess the sustainability of the business, prepare for tax time, and plan and forecast. First, income statement will track the cost of sales. Income statements let you track different types of sales and show the cost of the sales. That information can be used to gauge if your expenses are too high or your prices are too low. Second, income statement will assess the sustainability of the business. The income statement can help you determine if your business will generate revenue over the long haul. It can also inform decisions about entering new markets, investing in expensive equipment, and taking out a business loan. Third, income statement will prepare for tax time. The income statement can help with the latter. Whether you're filing your income tax quarterly or annually, you will agree to profit a lot of information about your business. With an income statement, the tax total is all there. And last, income statement will plan and forecast. The ability to plan and forecast is made much easier with income statement. Be able to analyze the trends in pricing and sales over an extended period can improve your ability to predict how your business will fare in the future. That's all I have to say about function of income statement. Let me turn now to the structure of income statement. What goes into an income statement? The income statement includes several pieces of key financial information that used to calculate profit and losses. They include the following items: operating revenue, non-operating revenue, gains, expenditures, cost of goods sold, operating expense, depreciation, owner draws, earning before taxes, gross profit, and net income. First, operating revenue. Operating revenue includes all of the money the business earns from providing a service or selling goods. Second, non-operating revenue. This is revenue earned from non-core business activities such as rent from a property the business owns or royalties from partnership. Third, gains, often called other income, this is money the business made outside of its core operation. For instance, it could be money made from selling a plane or an old vehicle. Fourth, expenditures. Expenditures are money spent on goods or services around the business. They are recorded at the time of purchase. Expenditures differ from expenses, which are typically offset over a period. Five, cost of goods sold. Known as cost of goods sold, these are the costs associated with selling a product. They include the materials to develop your goods and the labor to get them in the market. Fixed operating expense. These are the costs not linked to the goods or service you're providing. They can include rent, office supplies and utilities, among other things. Seven, depreciation. These are expenses that are spread out over a long period of time. The value declines as the equipment or vehicle ages. Depreciation varies depending on the type of business you're operating. 8, owner ground. This is the money you take out of the business to pay yourself a salary. 9, earning before taxes. This refers to your income before you pay any taxes on them. 10, calculate by subtracting the cost of goods sold from revenue. Gross profit is the profit of company nets. And thus net income. Net income is the income left over after you subtract all of your expenses from your gross profit. It's the most important line of the income statement. If your net income is positive, your business is doing okay. If your net income is negative, you may need to take a deeper look at operation. Now we move on to what are the types of income statement. There are the several types of income statement you can employ to stay on top of your profit and losses, with varying degrees of complexity. For small business owners, the single-step income statement and the multi-step income statement are the most popular. First, single-step income statement. A single-step income statement is the easiest one to create because it uses one calculation to ascertain the profit or loss of the business. Here is the equation used with a single-step income statement. Net income equals revenues plus gains, mean expenses plus losses. This type of income statement is simple to understand and easy to prepare, which is why it's commonly used by small businesses and sole proprietors that don't have several different sales lines. Companies that sell goods and services may opt to use the multi-step income statement. Second, multi-step income statement. Set by business that sell tangible goods or have more than one line of business. The multi-step income statement, as its name implies, uses multiple steps instead of one. With this type of income statement, the operating revenue and operating expenses are separated from the non-operating revenue and non-operating costs, losses, and gains. By separating operating income from non-operating income, A business owner can get a deeper understanding of his or her operation. The calculation to determine profit or loss with the multiple-step income statement include the following: gross profit equals net sales minus cost of goods sold, operating income equals gross profit minus operating expenses, net income equals operating income plus non-operating income. Well, I've told you about the types of income statement. Next, this is an example income statement for a fictional company. As you can see at the top, the reporting period is for the year that ended on September 28, 2019. During the reporting period, the company made approximately 4.4 billion in total sales. It cost the business approximately 2.7 billion to achieve those sales. As a result, gross profit was about 1.6 billion. Next, 560.4 million in selling and operating expenses and 293.7 million in general administrative expenses were subtracted. This left the company with an operating income 765 million. To this, additional gains were added and losses subtracted, including 257.6 million in income tax. At the bottom of the income statement, it's clear the business realized a net income for 183.2 million during the reporting period. That's all the example of an income statement. Now we'll move on to what the best practice is for income statement. First, setting up your income statement. Income statement is your revenues and expenses during a certain period of time and are typically generated on a monthly, quarterly, or annual basis. Pick the duration that you want to use to calculating your income statement. Businesses that are publicly traded must generate income statement on quarterly and annual basis to file with the Securities and Exchange Commission. Business also generate income statement on the periodic basis to identify business trend and evaluate financial results. At the top of the document, write the name of the company. On the line directly below the company name, write income statement. On the next line, write the period of time that the income statement covers. Income statement have four distinct sections. The first section of the income statement calculates gross profit or the total amount of money made from sales revenue and cost of goods sold. The second section calculates your total operation expenses. The third section calculates gains and losses unrelated to your operational costs. The fourth section calculates net income, or the money you've made in profit after subtracting your expenses from your revenue. Pattern preparing the gross profit section. Sales revenue includes all revenue earned from the sale of goods and services, regardless of whether or not the cash has been collected. This sales revenue for the period you sold. For example, say that you sold 10,000 units of inventory for $5 apiece, you will take a sales revenue of $50,000, even if your customers haven't all paid you yet. Cost of goods sold is comprised of the direct labor, direct materials, and manufacturing overhead expense you incurred to create the inventory that you sold. List cost of goods sold for the period underneath your sales revenue. For example, if you sold 10,000 units of inventory during the period and paid an average of $2 for each unit, you would record $20,000 for the cost of goods sold. If you're a reseller, cost of goods sold is typically the price that you paid to purchase the inventory. Your gross profit is the total amount of money you made during the period before your expenses. Relate the difference between your sales revenue and the cost of goods sold on the next line on your spreadsheet. For example, if sales revenue is 50,000 and the cost of goods sold is 20,000, you will record gross profit of 30,000 on the income statement. This agreement or Change the font color to show that the number listed is the profit. Third, totaling your operational expense. Operating expenses are expenses that directly relate to business administration. Next to each line item, list the amount of expenses incurred during the period. Common operating expenses include salary and wages for those employees not directly involved in the product of goods, rent, insurance, office supplies, professional fees, utilities, transportation expenses, marketing, depreciation, and property taxes. Direct labor has already been deducted from the cost of goods sold. If the business has a large variety of expenses, you can group similar line items into one category to set stage. For example, you can create an employee compensation line item that includes salaries, health insurance premiums, retirement benefits, payroll taxes, workers' compensation, and payroll processing fees. Add together the expenses to find how much money you spent. Take all of the items in your expenses list and add them together with the calculator. Write your total expenses on the next line of your spreadsheet. Use a red pen or change the font color to red to signify that the expenses should be subtracted at the end. Depreciation and amortization are both methods that reduce the recorded cost of assets. Depreciation is most commonly calculated using a straight line method, which is gradually reducing the cost of tangible assets over its useful life. Amortization is used for intangible assets and is calculated similarly to depreciation. Fourth, calculating gains and losses. Non-operational gains are revenues that don't directly relate to business operations, sales, and production. These revenues are from activities that are different or peripheral to normal operations, such as investment or unrelated sales. Next to each line item is the amount of revenue incurred during the period. Common non-operational gains include interest revenue and gains from the sale of securities. These items add to the income of the enterprise where expenses reduce income. Once you list all the non-operational gains your business has, add them together so you have one number for total gains. Put the total gains on the line directly underneath your list so you can easily find it later. Write your gains in green so you know that they're a profit. Non-operational losses also don't directly relate to the business operational or sales. Next to each line item, list the amount of expense incurred during the period. Common non-operational losses include interest expense paid to lenders, losses from results of investment, and losses from litigation. Add together everything listed in your losses section of your income statement to get your total losses. Write the total on the next line on your statement so you can easily find it later. List the total losses in red color code your spreadsheet, that way you know how to combine them with your other operational expense. And thus finding net income. Find the gross profit you calculate in the first section and the gains in the third section of your statement. Add the numbers together to find the total profit your business gained over a period of time. Locate the total operating expenses from the second section and your non-operational losses from the third section of the income statement. Add the two numbers together to find the total amount of expenses your business had. Take the expenses you just calculated and subtract them from the profits. Write down the net income at the bottom of your statement. Your net income could be positive or negative, depending on how much you spend and earn during the period of time. That's all I have to say about this type of income statement. In conclusion, income statement indicates profit or losses that the company earned at the end of period. If the net income is positive, then the company is profitable. Otherwise, if the net income is negative, then the company is losses. This is the reference I use for my presentation. May I thank you all for being such an attentive audience. If there are any questions, feel free to ask me on the comment below. Wassalamualaikum warahmatullahi wabarakatuh.